I discovered passive income when I became a real estate investor because when I bought my first real estate investment property, this property paid me something like a couple $100s a month in profit every single month. And this was money I didn't have to physically earn. This was money the tenants had to pay me because they were living in my property. I love real estate investing as a way to generate passive income, but there's a couple of downfalls that come with real estate investing. First, you need a lot more cash because you have to buy physical real estate. And second, you have to deal with tenants. If you're investing in real estate, you're gonna have tenants that slip and fall while they're taking a shower, and then they're gonna sue you because they will say that the bathtub was too slippery when it was wet. This has happened to me. If you invest in real estate, you are gonna have tenants who are cutting cucumbers on their countertops, and then they're gonna call you crying because they missed the cucumber and they slashed the countertop, and they're gonna demand that you buy them a new countertop. That has also happened to me. Now, you can hire a property manager, that way you're not super hands-on involved in your real estate investments, but if you don't wanna deal with the headache of investing and owning your own real estate properties, the next best thing is by investing in a REIT, a real estate investment trust, because now you're investing in a company that invests in real estate. The interesting thing about REITs for you is that they are required by law to follow something called the 90% rule, which says that they have to distribute 90% of their taxable income to you, their shareholders, through dividends. What that means is now you can go out and invest in a REIT on the stock market. So this REIT is a company that invests in real estate. You invested in this company, and now this company is going to invest in real estate. Now, anytime this company makes money through their rental income, they have to distribute 90% of their profits to you through dividends. So if I diagram this out, this is you. I'm gonna draw you a nice mustache. And if you go out and you invest in this REIT is a company that invests in this real estate. Now, this real estate, let's assume this is an apartment complex. These tenants are gonna have to pay your REIT, this company, rent, and then this REIT is gonna have to pay their expenses and pay their bills, and then out of what money is left, they're gonna take 90% of this money and they're gonna distribute this money out to people like you, shareholders, through dividends. Let me give you a couple examples so you know what to expect when it comes to returns. I'm not telling you what to invest in this video, I'm just giving you examples, that way you can get an idea of how this type of passive income investing works. And while I'm at it with the disclaimers, I should also tell you that investing has risks. You are never guaranteed to make money when you invest, you might even lose money, so always do your own due diligence and never blindly listen to a random guy on YouTube. SPG is Simon Property Group, and this is a company that invests in a lot of mixed use and major property developments throughout the United States, and they are paying a 6.5% annual yield. So if you invest $1,000 into this REIT, you are gonna get $65 back in passive income without doing anything, and you also don't have to deal with any tenant issues because your REIT, the company, is gonna deal with that headache. So you're investing in a company that's investing in real estate, and your company is doing all the work and all the headache and all the management stuff with the real estate. You're just getting that passive income. NLY is Annaly Capital Management, and they do something a little bit different. So they don't actually own the physical real estate properties, they own the loans. They invest in commercial mortgage-backed securities, and they pay an 11.5% annual return. So if you go out and you invest $1,000 into NLY, you will make about $115 in passive income while doing nothing, while this company does the work. And the bigger the dividends get, the more risk there is, so these are things you want to keep in mind. At this point, what a lot of people start doing is they start Googling how to find the highest dividend yielding stocks, and then they just invest in companies that are paying the highest dividends. As somebody who did that during his college years, let me give you a little bit of a warning. You should never solely make your investment decision based off of what dividend a company is paying, because that dividend yield can be very deceiving. Let's say you want to invest in this hypothetical company that is trading for $100 a share, and they're paying a 5% annual yield. So if you invest $1,000 into this company, they'll pay you $50. If you invest $100 into it, they'll pay you $5 over the next year. Now, what you want to pay attention to is how strong the actual company is, because let's say this company starts to do really bad, they start losing money, and they're on the verge of bankruptcy, and this stock tanks in price. They go from $100 a share to $20 a share because they're doing really bad financially. At this point, if they have not adjusted their dividends yet, it will look as if they're still paying this $5 annual yield, right? This is how much money they were paying here, and assuming they haven't adjusted their dividends, it will look like they're paying a $5 annual dividend for a $20 share price of the stock. That is what? A 25% return on your money. So people might look at this and say, wow, this company is amazing. They're paying 25% a year on my money. But what you don't understand is that this company might be on the verge of bankruptcy. So yeah, you might make a little bit of dividends, but then next thing you know, this company could go bankrupt. Or if they don't go bankrupt, they can also cut their dividends to zero, and now you are owning a company that is not really doing anything. This is why it's very important before you start investing in companies for the dividends that you're analyzing their financials and you're analyzing the fundamentals of a company. That way you're investing in a company that you want to own that is going to be more profitable in the future than it is today. If you enjoyed this short clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to start generating passive income, our team put together an amazing guide on how to start generating passive income for free. All you got to do is click that button right over there. Thank you for watching, and as always, keep hustling.